Robert asks, I have been searching for weekly strangles with an 85% or higher strike to expire worthless. My question is, if one side is tested, is it better to defend the position by rolling down the untested side for more credit and possibly rolling the tested side to following week, or is it better to take a stop loss based on the credit received? All right, so what are we talking about here? What is a short strangle? It's a combination of selling an out-of-the-money put that we were talking about before for Stefania and an out-of-the-money naked call that we were talking about briefly for James. We're selling two naked options, so the margin requirement can be pretty high. It's some combination of the cash secured naked put plus 1/3 the premium of the short call, or half the premium of the short call. I forget what the brokers are doing now. I don't trade this on a regular basis. But that's the position. We're in a naked call and a naked put, same expiration, typically both the same range, as you mentioned, out of the money from the current stock price. Let's take a look at a quick example here. I should have just stayed where I changed. Let's go to initial values. It's probably looking out to October. It is. I'm going to use Roblox. That's going to lead us into a different discussion in a moment, but we're going to take Roblox on for an example. Just a small move up today of 153, about 3%. Roblox is at 87.88. I can sell the 100 strike call for $1.85 and the 75 strike put, both about 12 points, 13 points out of the money for $310. Total net credit. Probability, I don't think, the probability sum is 2790. That's the probability between, sort of a little bit different. But let's see if I have my screen here, my filter. Oh, percent probability between. This might take off the DraftKings one the Roblox one I was just looking at, but let's see if any match. No, none of our defaults match. So in any case, he's going far out with weekly spreads, and I might have to change some of the criteria. Let me just go back to that 75. Sorry about that, folks. That was 75, wasn't it? Okay. Yeah. Okay, so let's just take a look at the profit and loss chart. Again, naked put at the 70 strike, naked call at the 100 strike, pretty much right between the two legs. And Robert would be looking for an 85% probability between. I'd have to change the criteria to look a little bit more. And he was using weeklies. The return looks small because of it's showing the full monetary requirement for the naked put and the naked call, the way it would be calculated. $7,000 for the naked put for one contract, and a portion of the 100 call. And so we're getting that 249, 250 net credit in any case. What's the purpose of this? As long as the stock stays between both strike prices, Roblox does not move above 100, does not drop below 70, both options expire worthless, and you keep the net credit that you received. That's the goal. Just like we were talking about on the naked put position, if the stock starts to threaten the naked put or the naked call, and Robert, you don't need to use this, but I would consider also using the 1% rule, as I would use in an Iron Condor position that we're going to talk about in just a moment. So I don't let it go in the money if possible. If it gets in 1%, yes, I might consider rolling this up if I can still roll for credit. You're doing weekly, so you probably have to roll out further in time. You're not going to be able to roll the same expiration, obviously. So you would look to roll it based on that situation. And you'd probably have to go further out. So the question here is, one side is tested. Is it better to defend the position by rolling down? Okay, so if it went this way, is it better to roll down? But you're going to have to roll further out in time. I don't know how your broker handles it, Robert. And this was part of your question. Let's say this is a September 17th expiration, as is this one. We're looking at September 17th. And next week, Roblox falls back and has something disastrous, and it falls down to $70.70, $71. It's right at my 1% rule. I buy this back. It's going to be much more expensive than what I initially collected based on the at-the-money bell curve, which means that I might have to roll this out from September 17th out to October standard expiration to get a credit. Now, I can buy this back more cheaply. That's working in your favor. But if your broker gives you a certain discount for being in a short strangle, what you'd also have to do is roll this option as well, meaning the margin requirement you'd have to cover, Robert. You have to roll this one out to October as well. Otherwise, if I'm not mistaken, they would no longer see it as a short strangle. they'd see it as an October naked put and an October naked or a September 17th naked call. But following the same discussion we had, about 40, 30 minutes ago, at what point is it worth it to keep rolling if the stock continues to go against you? Or even on the upside, is it worth it to keep rolling if the stock's going up? It's now showing you more of a trend that no matter, even if your delta is 0.3 with a 70% probability, 0.15 with an 85% probability, or you have an 85% probability between. If the stock is now breaking out of a channel, either direction, and is showing a more pronounced trend, bullish or bearish, why get in the way of either freight train? Maybe get out of it, take the little bit of loss you have, just as we discussed before. Look for new short strangles that meet your criteria on more channeling stocks, which is what you want for this or for an Iron Condor structure, and continue the trading plan. Yes, I agree with your idea that it's a good idea to roll the one that's looking into trouble, especially if you can get this back so the stock's falling. I want to get out of the way of the freight train here and roll this down maybe to a 67.5, maybe a 65. Maybe I have to go out 2 weeks or 3 weeks to get the credit from what I had to pay to buy this back. But I can buy this back, maybe come down here a little bit and recreate the strangle. But you got to watch out for more volatile stocks because you can get whipsawed on both sides in this case. Same with an Iron Condor. Would I ever use a stop based on the net credit? So we took in 250. And what Robert's referring to is, should I set a stop in this case where if this goes, the liquidation value, the liquidation cost of buying to close the call and buying to close the put exceeds twice the credit I received or moves up to $5, or it goes 3x, so it's at 750 because one of these increased drastically. Yes, I'm buying this back more cheaply, but I'm paying a lot of money to buy this back. The concern I have with that, and you're using weekly positions, so I think this would work out better with a weekly. But the concern I've always had with this, and in discussions we've talked about managing bull put credit spreads, managing bear calls, I never use the net credit as a trigger point or a stop for my bear call credit spreads or my bull puts. Why? Because they're usually 2 to 3 weeks out in time. And if there's any market shift or change in implied volatility because there's fear of some event coming on, fear of some announcement coming up, not just for my stock, but for the market itself, if implied volatility increases, my stock doesn't even move, the liquidation value could hit 2 to 1. I got 20 cents in net credit for a position where I'm still about 3-4% out of the money and expires in 7-8 days. The implied volatility of the market sort of shoots back up from bad rumors happening, geopolitical events, something going on, but the stocks haven't moved yet. The volatility is increasing. I might be at a 45, 50 cent buyback cost, 2 to 1 from the 25, 26 cents I collected, even though the stock is still the same range. I understand why investors use it. I want to keep my losses realistic. I don't want to lose 2 to 3 times of what my average credit is or my average premium is, so that if I do take a loss, I only need 2 trades or 3 trades to get back to break even. It's not a bad idea, Robert, to use that. I just wanted to address the caveat that you may have to consider if there's suddenly a change in implied volatility or you're getting closer to earnings in that case, then this, Robert, is where you'd probably consider not necessarily rolling it, even though it's at 2 to 3, because it's still in the same safety range that you were before, but it is pointing to something coming up on the horizon, either on the broad market or for your individual stock, and you'd want to pay attention to that, Robert, as well. Okay, so again, general stops I would use, 1% rule. When you got into this short strangle, you were probably hoping the stock was probably in a channel of some kind, whether you were using Bollinger Bands, whether you were using any kind of channel indicator, things like that. Whatever you're using, a tighter Bollinger Band width, if you see it break out on the upper or lower Bollinger Band, the stock reaches within 1% of the short call strike or the short put strike, those are usually stops I consider. If the technicals change from what I would use to get into a position that matched my criteria here, or if it hit the 1% rule, I would look to make an adjustment on that as well. Net credit is a good idea to try to control your risks, but you can see an increase in net credit that might hit your 2-to-1 or 3-to-1 stop point with simply a change in implied volatility without the stock moving. Of course, if the stock falls down, has a sudden 4 or 5% decline downwards, as we all know, what's going to happen then? What's going to happen then is the implied volatility on the put is going to increase because fear in the market, and it's getting closer to the at-the-money bell curve, so it's going to be very expensive to buy that put back. Rolling it is probably a good idea, but you have to analyze, why did this stock fall? Why is implied volatility higher than I thought it should be? What's going on? Because if it looks like there's going to be continued turmoil or whipsawing on the stock, you might not want to rebracket the whole Strangle back again. You might want to take the loss, move on, and look to make it back with your trading plan. That being said, let's jump right back now to Stefania. And Stefania had one or two more quick questions here via email. I wanted to separate that, and when I saw the questions come in, I thought this was a good idea to do. We just talked about a short strangle, selling an out-of-the-money naked put, out-of-the-money naked call on a stock, usually right between the strike prices. You get that good probability between. What's an Iron Condor? Well, you're still selling the out-of-the-money put, but now you're also buying a lower strike put for protection in a sense. You're still selling an out-of-the-money call, but you're buying another out-of-the-money call at a higher strike price for protection. Essentially, what you're doing is combining a bull put credit spread, sold put, long put, with a bear call credit spread on the same stock. And Stefania's question came into, looking at Iron Condors on SPX, what are the parameters and why the margin required is very low? Is there no risk to be assigned, as this is one of those different assets? Well, SPX, it's a European style expiration, so you can't be assigned anything, but you would have to do cash back. You're used to selling naked puts, where you're putting up the full cash secured amount for the strike price. You're looking at a maximum margin requirement on an Iron Condor, and it's only $1,000. Or, a 10-point spread, it's only $1,000. Why is it so low? Because you can't lose more than this. If SPX drops below both strike prices, you may be forced to do the cash buyback here, but you can sell to close this one here for the cash difference, and all you're losing is the difference in strike prices. That's all you have to cover. And most brokers realize what the Iron Condor is, that when you initially structure it, you can only lose on one direction or the other. So they're likely only going to charge you the margin requirement if entered as a 4-leg spread on one side, just like they would for a bear call credit or a bull put credit spread. That's why the margin is low. Let's take a look for the parameters. Just as Robert had mentioned in relation to the Strangle, what are the criteria one would look for if you were just looking at SPX? Very similar. What does this strategy have that a bull put credit spread doesn't, a bear call credit spread doesn't? It has that filter for probability between. The theoretical probability the stock's going to stay between the two strike prices on your expiration date. Because the goal is, just as a short strangle in the Iron Condor, you want all 4 options to expire worthless because you keep the net credit. You can't lose more than the difference in strike prices on one side or the other minus the net credit. That's why the margin is lower. You only have to cover that difference in strike price amount. But you're going to look for an 80 to 85% probability between. You're going to look for a probability 75 or 80% just above the short put strike and 75 to 80% above the short call strike price. You want to be 1 or 2% out of the money. If you're going for a monthly SPX Iron Condor, I'd say maybe 2, 3, 4% out of the money. Weeklies or 10 days out, you're going to be looking 1 to 2%. And you want the leverage to work in your favor. So you want a minimum return at least 5%, maybe 9% or greater in this case. And as we found with bear call credit spreads, we usually see the best returns going 1 to 2 weeks out in time. So I'm going to look just 1 to 2 weeks out in time. Iron Condors on SPX, minimum 5% return. And what's this filter here? I'm going to talk about that later. Percent out of the money range of 45 to 55%. So we've got a lot of results here. Most of them, let me just go ahead and put the credit back in, a percent return, of at least 9 back in. There we go. So now it's down to 39 total results, mostly 7 days out to September 17th expiration. There are the Monday, Wednesday, and Friday expirations now, but let's just keep it simple at this time. Now, it's great to see all these numbers. We see a 12.4% return with almost an 80.6% probability. Here's one with an 81.4% return. I'm sorry, 81.4% probability, 12.4% return. Let's take a look at that. What are we doing in an Iron Condor? With SPX at 4,458, this potential trade is selling the 43.20 put for 14.10. It's a 5-point spread. Probably would go with a 10-point, but this is okay. Buying the 43.15 put for 13.70. That's a bull put credit spread. We sold the put. We bought a put 5 points lower. So all we have to do is cover that 5-point difference for the difference in the two strike prices, 43.20, 43.15. At the same time, I'm selling a 45.75 call and buying a 45.80 call. Bear call credit spread. Again, 5-point difference in strike prices, but most brokers will say, hey, you can only lose on one side or the other, can't lose on both, so you only have to cover the margin requirement for one side of the trade or the other, not both, in most situations, okay? So what does that leave us to? That's the Iron Condor position. Stock's almost right between the two strike prices. As long as SPX stays above 43.20 and below 45.75 in the next 7 days, all 4 legs expire worthless. We keep the 55 cents against the $5 margin requirement, a really true risk of 4.45. That's our 12.4% return in that situation. Okay. It's cash secured, meaning if I did let it go below the short call strike price, let's say it went to 43.18, I'd have to pay $2 at settlement to close my 43.20. All 3 other legs expire worthless. It drops to 4,300. Now I may have to pay $20 intrinsic if I left alone to expiration and didn't adjust prior to that, but I'm also going to get $15 intrinsic back for the 43.15 put. That's the most I can lose on the position, is the difference in strike price, and I keep the 55 cents, so I'd lose 4.45. Like most credit spreads, though, you kind of see the risk here of letting it go to full risk. This is almost a 9-to-1, 8-to-1 risk-reward ratio, meaning that if I let it go to full loss and didn't adjust it beforehand, I've wiped out 8 previous gains by taking that full loss on the position. The risk is low. You would ask about the risk because I just have to cover the difference in strike prices. It's one vertical spread and another vertical spread. I only have to cover the difference in strike prices minus the net credit. But the criteria, again, what I'd look for, 85% probability between, going 7 to 14 days out, 7-8% minimum return or higher. And what was that 45 to 55% out of the money range? That filter allows me to target that I want the stock to be between the two strike. I want it to be almost equidistant between my short put and my short call. If I was more bullish on SPX and I wanted to skew an Iron Condor, I'd never recommend doing this. But if you wanted to, absolutely. Let's say, what do I mean by skew? Let's say that right now you're more bullish on SPX for the next 10, 15, 20 days. What if I skewed it instead? So where the stock was here, what if I just sold the 4,400 put and bought a 43.95 in that case, but still did the upside? Why am I doing it this way? Because I think there's less likelihood that the stock could fall, the SPX could fall 58 points, but I think it's more likely it could go up this way. What does this mean by skew? My percent out of the money range that I showed would be closer to 30% because it's skewed to the downside. It's more bullish. If I put a 70% probability between, I'd be more skewed to this upside, meaning that I'm more bearish on SPX. I'm trying to sell closer to at the money calls because my expectation is it's going to go this direction. But I like to go right in the middle. That's why I put that percent out of the money range filter to be between 45 to 55%. So try to isolate it right at 50%, which means it's equidistant or close to it. Short call strike, short put strike as well. Okay. And very quickly, this leads us to another idea. What is the great advantage of the short strangle we talked about for Robert? The naked put that we talked about a little bit earlier, the Iron Condor. as we get closer to expiration what's happening. As long as the stocks between the strikes here or above here, our puts, our calls are getting to zero. They're getting closer and closer to expiring worthless because we're experiencing theta decay. Last little quick discussion here for Stefania. Oh, there we go. Sorry about that, folks. Comes down to a simple question: what is theta? As it relates to sort of these concepts and these ideas. I'm sorry, folks. There we go. All right, sorry about that. What is theta? The correct question is, what is theta? How can we interpret it? And how is changing over time with the option till expiration? Is it meaningful to use theta as criteria to evaluate the performance of the price of the put option? Okay, time decay. Theta is the amount of decay you'd expect on a daily basis for your option. The time decay curve. What do we know about the time decay curve? Well, if I buy or sell an option that's 120 days out, I'm going to see a very slow time decay, assuming stock stays the same, implied volatility stays the same, and everything else. It's going to decay very, very slowly until I get in the last 30 days. The last few days or so are very rapid. But it works the same for a weekly option if you're considering that, or even a 2-week out. This is from the OIC website. It was really good graphic. An at-the-money option has more time value. In fact, it has the highest time value of any option around it for the same expiration. It's known as the ATM bell curve. This might be 7 days out, 6 days out, 5 days out, 3 days out, 2 days out, 1 day out. The same thing talking about a month time decay and how the last 30 to 15 days when you see the most rapid decline is essentially the same you might see on a weekly option. Meaning that I start off and I sell a weekly at the money call for $1. And my theta might be 0.25, which means what? If the stock stays the same price, volatility remains the same, that I'd expect to lose, that's probably high, but let's just go with it. I'd expect to lose 25 cents on the first day. Then my theta might go up to 30. Then it might go up. Yeah, I'm way too high now, aren't I? The point of the matter is that you're going to start seeing the last day to expiration. You might still have 40 cents left. So this might be a 40-cent theta going to expiration if it's still slightly out of the money. Here it might have been, okay, better. It might have been a 10-cent theta for 1 day out and then moving up to 15 or 20 and then moving up to 30. And so the last day you see the most rapid time decay. Just like in the last month, you see the most rapid time decay on the position. Static, when you open a position and you see a theta, is it telling you anything about the performance of the stock? No, it's telling you if it's in the money or out of the money. If you have a lower time value, you have a lower theta, that means you're in the money where most of the premium is intrinsic and the time value is low, or you're out of the money in that case, meaning the time value is low. Does it tell you that the stock is bullish or bearish? Absolutely not. If you compare two 50 strike puts on stocks trading around $53, and one has a theta today for 7 days out of let's say 1.6, and the other one's 0.05, what is that telling you? Well, it's telling you the one with a theta of 0.16 is a higher implied volatility and a higher premium. It might be more volatile. That's what it's telling you. It's not giving you a bullish or bearish indicator. And you did have that follow-up question, of course, with talking about the link to IV and how is it changing over time of the option? Well, it's decreasing because it has to. If it's staying out of the money, it's decreasing because you're losing time premium. But theta is going to change with the moneyness. The at-the-money bell curve, if you look at any option chain today for next week's expiration or for October expiration, what you're going to see is that the option that's at the money has the highest time value, not the highest price. So think about here on a call, and this is $50. The 50 strike is going to have the highest time value, thus the highest theta. Now let's draw that wrong. The in the money call, let's say down to the 45 strike, it's going to have a premium of say $6. But 5 of that is intrinsic. Only 1 of that is time value. This might be priced at 2. And we go to the 60 or 55 strike call out of the money. This is all time value, but it might only be at 1. The highest time value is here. But if my stock moves up, then later on, let's say 2 days from now, my weekly call, the stock's at 55. The 55 strike at that time now has the highest time value. This price is increased. It might have gone up to $2.80, $2.90, $3, but $2.50 of that is intrinsic. The rest is time value. So it's only going to see a decay. This only is going to decay $1 in theta, in time value, over the next 7 days. This originally was going to decay too, but now that it's deeper in the money, it only has 50 cents of time premium. So theta is going to drop because it needs to lose less over the next 5 or 6 days now that the stock has moved up. That's the at the money bell curve. This one's showing puts, of course. So if I sold a 70 put that was at the money, no, I'm sorry, I sold an 80 put that was at the money, but the stock fell to 70. I have a higher price. It's going to be worth $11, but it's only $1 worth of time value and only $1 worth of theta because now it's deep in the money. Meanwhile, that 70 put that has 5 days to go might have been trading only at 30 cents, but it might be trading now at $2, $1.50. Now that the stock has fallen to that price. Okay. So is it meaningful to use theta as criteria to evaluate performance of the price of the put option? No, it's not giving you a bullish or bearish indication. It's just showing what your expectation is. But theta is going to keep changing as the put goes further out of the money, or the put goes in the money, or the option goes out of the money, or in the money, or at the money. If the option's right at the money, at that time, it now has the highest time value of any of the options around it, so it might be increasing in price as well. Okay, the theta might be increasing because the price increased and it's still time value. Related to performance, it just means potentially higher IV. If you're comparing two of the same strike puts with the same strike expiration on similar stock, one has a theta of 0.16 and one has a theta of 0.08. The one that has double the theta has a much higher time premium because it probably has higher implied volatility. Okay, your lower thetas are going to start at out of the money and in the money. The higher theta is going to be at the money. But as the stock keeps moving down and the out of the money options come at the money, theta is going to shift because it's got a higher premium now. It needs to decay more.